Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. I'm really excited about this show. It's with my friend, Mike Zane, and we're talking about the ins and outs of real estate fund administration. Mike's company is called Lexcraft Advisors. It was founded on a simple premise to provide middle market commercial real estate funds and syndications with tailored fund administration support, typically reserved for institutional investors. This is a different kind of show, but you're going to like it. Let's go. This is episode 270 of Zen and the Art of Real Estate Investing with my guest, Mike Zane. Mike is the founder and managing partner at Lexcraft Advisors. They are a CFO services firm that supports middle market real estate investment funds and syndication groups. He also has prior experience at PricewaterhouseCoopers and in the real estate finance business at JP Morgan Chase. Mike, welcome to the show.
Thank you, Jonathan. It's good to be here.
Yeah, you know where I'm going to start. It's not going to be about real estate. The audience is now listening to the two most monotone people in the world. We are going to set this place on fire.
Let's do it. I'm excited.
Yeah, well, it's good to have you here, and I'm really interested in the background to how you got to this part of syndication. So tell us your story of why real estate after your degrees were really in business and economics, and how you got into the back end of syndications.
Yeah, that's a good question. So you're right. I mean, I've got degrees in mostly finance, have an accounting degree at the grad level, but I ended up almost just through happenstance at working at JP Morgan. I was in the real estate finance group there. So that was kind of the first professional foray into real estate. I mean, this is going back 12, 13 years at this point.
Yeah.
So kind of cut my teeth there, got to understand the finance side of real estate in a way that, you're not going to really learn in school or anything. It was more that hands-on approach, and learned some pretty solid, analytical skills back there, kind of the technical side of it. So that was, in hindsight, very fortunate, and I'm lucky to have gone through that. That kind of translated into a role that I had at PwC for a good 5 years or so, where I was kind of straddling two different sides of the business. So on the one hand, I was doing strategy and advisory work for major finance companies. A lot of it was focused around the commercial lending aspect and standing up different in-house ops programs at some of these companies. And then the other side of what I was doing there was on the audit side, so very accounting heavy stuff. And the clients that I was working with there, again, were in that commercial lending space. There's some esoteric assets in the commercial real estate finance field, and so we were building financial models to kind of check the valuation of some of these odd asset groups that you don't hear too much about, but. So that was kind of the hands-on accounting side of my professional background. And so the shops we were working with back then, I mean, these were some of the largest private equity firms, banks, what have you, out there. And I vividly remember sitting, I think I was in Minneapolis one day at a client, and I remember sitting down and kind of thinking to myself over lunch one day, I think there's an opportunity to kind of take what I'm doing here and kind of this skill set and this interest that I have and scale it down. And really the thing that you learn with management consulting is that it's all about the relationships.
Yeah.
And so if we kind of translate this relationship-centric viewpoint into, this middle market of real estate, I just couldn't disprove to myself that anybody was doing this. So it was in 2021, made the jump, started the business, was able to, kind of through luck, grab a couple of sort of smaller clients to start. And, here we are. It's been 4 going on 5 years.
Yeah, when you were doing, when you're looking at all the back ends and accounting and kind of all of these documents, obviously you identified this, you said before, as a place where not a lot of people were doing it. But isn't this also a field that nobody really likes to do when they're part of the syndication, and this is like in your wheelhouse?
Yeah, look, if you're a fund manager, you're managing a portfolio of syndicated deals, you are probably focusing on the deal sourcing side. You're probably focusing on the capital sourcing side. And I think that's the right thing for folks like that to be focused on. If they're not focused on that, nobody else is going to. And, it's really hard to have a business if you can't achieve those two things and succeed with those two things. So, I think that there is this aspect in some cases where especially newer sponsors will attempt to kind of DIY the back office aspect of their business. And, some folks have the background to sort of do it, but at the same time, there's sort of this scale limiting factor to going about it that way.
Isn't it though? I know we talked about this before when we were setting up for the show, but it's interesting because I think you're right. I think the best focus for someone who's either starting a syndication or working on a fund or even has experience, like you have to get the money and you have to get the limited partners, but where the limited partners get the best experience is in the back end, right? And this is where you can get them in and then you really fail on the deliverables and the kind of, asset documentation for what people want. And then that just leads to more complaints, which makes it maybe seem like it's not as good an investment just because the back end's not cleared up. Am I right about that?
Yeah, I feel the same way. Actually, we think about obviously our clients are the sponsors or the fund managers, but in a sense, we're thinking about our customers as the investors.
Yeah.
And how do we give those investors a good experience on behalf of our sponsor partners? So I view that as my real job. And I think you're right that unfortunately there's enormous disparity in the private equity space and especially in private equity real estate, where some shops are really good about the way that they kind of treat their investors and interact with them. And some aren't. And that goes from everything from, documentation to ongoing investor reporting and just general communications.
Yeah, based on your experience, do you think it's an actual experience issue for those people who are running those funds? Because from what I've seen, when the initial pro forma or docs don't look good, it usually just means they don't have the operational experience to make it deliver the way that I'd like. And then, of course, the people who go into that fund, if it's a first or second, the monthly deliverables are not going to look what they expect, maybe. Or maybe they don't know, but I think that can be a big letdown.
Yeah, our client base kind of splits into two groups. We do have this niche where we help first-time fund sponsors or equity raisers kind of stand up their platform.
Yeah.
So, in a case like that, I think what you're saying is spot on. The experience might just not be there to provide that great investor experience that we all want. On the other side of our business, where we're working with sponsors that, maybe they're 10 or 12 syndicated deals in, or maybe this is their second or third fund, they typically know what good looks like and what bad looks like. It's really a matter of, do they have the operational side of their business in order in a way that can kind of deliver on that. So in those cases, it's more about us kind of working with the sponsor to say, hey, this is what we think. What do you think? Kind of put it together and then build out the platform to be what we all kind of collectively think it should look like.
Yeah, I mean, well, this is a good point to go over exactly what you guys do for these syndications and funds in the background. We've touched on it a little bit, but I think it'll clear it up for people because you're trying to provide this back end experience. And like as you were saying before, your client is a GP, but who you're focused on is the LP because that's what's better for the GP.
Right. Yeah. So, like you said at the outset, we're a CFO services firm. We're focused entirely on the private equity commercial real estate sector. Some folks might call us a fund administrator, depending. I mean, it's kind of a blurred line, but
yeah,
if you're managing a blind pool fund, yeah, we provide fund administration services for something like that. And really, what that means is two things. One, we handle kind of the financial back office financial aspect. So, we're everything from your bookkeeper up through your controller, up through your outsourced CFO. We handle the tax reporting. We interface with your tax prep shop to make sure that that's all running smoothly. The other half of that is the investor management component. So we're standing up a software platform to manage the investor base, manage the people who are providing the capital into your investments. So that encompasses things like I said, standing up a software platform to kind of manage everybody, putting together upfront collateral to assist with a fundraise. So we would build out, let's say, an offering memorandum for somebody. So it's a visually oriented document. You could call it a pitch deck. So that's kind of step number one. And that goes out to the investor base or the prospective investors to help with the capital raise.
But that's pretty awesome because then your pitch deck is directly tied to the actual numbers. Right. That's like sometimes you see a pitch deck and you're like, this doesn't really, there's three things that all don't make sense together. But if you're doing the pitch deck, it's based on all of what you're seeing in the background and controlling. So it makes it, in my opinion, more reliable of a pitch deck.
Yeah. And in a lot of cases where you're also sort of, I would say, project managing the build out of the acquisition or the underwriting models that our clients use to underwrite their deals.
Yeah.
So, there is a nice integration there where the numbers that are going into the pitch deck, those are solid. We've kind of worked those through with the sponsor and with whichever party is doing the financial modeling.
Yeah, and it allows, especially for newer sponsors and even experienced ones, to not have that as a full-time position. They're able to save on a salary and use you guys while you can do that for multiple parties. But at some point, if they get big enough, is it inevitable that they just start to hire that in-house when it gets bigger, or does it depend?
So I think our largest client right now is managing about $2 billion in assets. And what we find is for shops that are sort of in that range, we can still provide a lot of value. It might be more targeted where we're signing up for a specific scope of work.
Yeah.
I'll give you an example. We have a larger client where we're the exclusive pitch deck provider. So they have somebody doing the underwriting in-house. We work with that group to put together, the collateral.
It makes sense, though. I mean, if you look at the world of syndications and where things break down, this is the area where you can mess up the most and actually get the most complaints because it's all about the money and the expectations, right? And the pitch deck is what builds the expectations. But if the pitch deck isn't correct and based on actual value, this is where a lot of people have gone wrong or missed the debt side of it.
Yeah, for sure. And I think it's also a matter of what type of investor you're trying to really connect with. So we will sort of interview our clients, our sponsors, before we put together the collateral. And it's kind of a question, hey, are you looking to raise retail equity $50,000 at a check?
Yeah.
Or are you looking to go, for maybe family office money or institutional money? And we kind of craft the message to sort of align with what we all agree the target profile is going to be.
I mean, that's really important because there is a big difference. That 50,000 check is just going to be your regular person, like me. That's what I invest between 50 and 100 into deals. But family office is obviously a different pitch. It's going to be much more in what I would think number friendly, like just the facts, man. Don't really need, it doesn't need to be a shiny. They just want to see the bottom line and they know what all those numbers are that you're sending.
Yeah, and they typically have the resources to dig a little bit deeper and do more due diligence. So we try to get out in front of that.
Yeah, I mean, it's really interesting, though, because I've had so many syndicators on the show, and obviously we don't talk a ton about the back end, but we do talk a lot about what it takes to raise, what it takes to keep people coming back. And part of what keeps people coming back, and I mean, the point of what, sponsors really want is just repeat customers so they don't have to be out there like they were on their first deal hoping to get someone. But the consistency of the back end is something that I know from being an LP helps me say, hey, I want to go with them again. Not only are the numbers good, but the deliverables, I know what I'm getting.
Yeah. Yeah. And I think that comes from, right now we're building out a quarterly investor reporting cadence for one of our clients. These guys, they have a portfolio of syndicated deals, but no reporting capability. So we're now in the process of putting that together in a way that I think is going to go a long way with the current investor base and make them feel a lot more comfortable, with the idea that it also gives the sponsor kind of this quarterly touch point with their investor base where they might not hear from them, as often as they would like. Gives them an opportunity to kind of check in. They might also be able to say, hey, investor, we've got this new deal coming down the pipeline. Look how our others have performed. Do you want to talk about this upcoming one? So
yeah. In terms of first time, founders, sponsors, the ones who are trying to get it off the ground, where are they going wrong when you come in, you do some consulting, or they hire you and you're like, woof, this isn't set up the right way. As you've seen it, where are these first timers really having the biggest struggles for those people who are listening, who are like, hey, one day I'd like maybe to start a syndication of my own?
Yeah. Well, I think there are a couple of things. One is track records raise money. So that's
they have none. They have to create it.
That's right. So that's a difficult thing to overcome. You're probably at that point, it's a matter of kind of how are you going to structure that first offering. Maybe it's not a $50 million fund. Maybe it's a joint venture with a single investor who you get to know, and you do one deal together to get started and to build a track record. And we've seen that work pretty well. So I think that's one part of it. The other thing is, accounting is very important, and it's something that emerging sponsors typically don't give a lot of thought to.
Because they're focused on getting money, but not accounting
understandably.
For it. Right.
So, I would just say to all the first time or newer sponsors out there, don't ignore your bookkeeping. Find a good CPA, find somebody who can help you on that front.
Yeah, especially in the beginning. I have seen that sometimes the first time sponsors, they've done a lot of friends and family deals. So at least they have metrics that they can show that say, like, here, I had 6 investors, this wasn't a syndication, but here's what we did on these, a couple 4 families or something. Do you find that helpful? I feel like that's at least like the beginning of a track record, even though it's not like a full cycle deal syndication.
Yeah, it's funny because we see sort of this common thread between new sponsors, like, first time equity raisers, and also we've had family offices, like fairly big family offices, come to us and say, hey, we have this sort of portfolio of property that we purchased with our own cash with no outside equity. And in both cases, these two groups now want to go and raise outside equity for the first time. And it's a matter of how do you kind of put together the story to explain where they've been.
Yeah.
Whether it's that 4 family or whether it's that, 100-unit multi that they just happen to buy with their own cash. But it's sort of a similar process where you're going back through the history of the project to pull out the financials, to put together the performance metrics on it, and then figuring out how to put that together in a narrative that kind of resonates, again, with that target investor profile that they're shooting for.
That's what I was thinking. Very similar to developing the avatar for who they're looking at, because, again, those are completely different things. Showing off the 7 multifamily deals that you did, which were all 4 units and under, or a family office that has widespread credibility, like you said, bought for cash and now is like, well, I'd like some of that cash back.
Yeah.
So let's bring in some cash. Yeah, again, those are different pitches, but also really important to think, because the way that I think of it is the pitch is really important, and having someone who can tell you, hey, these are different pitches, is kind of what you've heard me say over the years in off-market acquisition. It's like, for everyone who just sends, hey, I'll buy your house for quick for cash, no one wants that off market. So people who are, like not only interested in syndications, but looking at buying homes off market, you can't send the same pitch to everyone, because it doesn't, your end result is going to be lessened by that very, commodified pitch.
Yeah, I would agree with that. I think it even comes down to the language that you're using in your pitch. So if you're targeting, say small institutional money, you need to be able to speak in a language that those guys are going to understand. So
no, I think it's really important. I mean, it's definitely shining a light on ways that I've read pitch decks where I thought, this isn't really targeted towards me. And I mean, I have experience, but I didn't have a ton of experience in syndication. So when you get the pitch deck, like, it's actually too much for me. Even for someone who's been in it for so long, it's just, there's so much in there. You really need to know where to look. Is there something in a pitch deck that you would tell a first-time LP, like, hey, focus on these few things, if you just want to kind of get your general overview when it just looks like, they've fallen onto an accountant's spreadsheet hell?
Yeah. So I think that most of the collateral that we put together for first timers or for emerging sponsors, it focuses on the strategic, kind of like the strategy behind what they're doing. So, we have clients who maybe they're geographically focused. Maybe they know a particular market really well. We're probably trying to shine a light on that, because even if the track record's not that deep, we can legitimately go out to the prospective investor base and let them know, hey, we've been, working in XYZ city for 10 years in different capacities. We know it like the back of our hand, et cetera, et cetera. So I think that's a great way to kind of break in from that standpoint. So, it's stuff like that we try to focus on. I think every piece of pitch deck collateral that we produce does have some kind of pro forma view.
Yeah.
So, we're not really going to send something out to market without some kind of financials in it. Now, to what level of detail do those financials need to go? That's probably the core question. And I think that gets back to what we talked about before, who's your target profile?
Yeah. And have you seen what you're producing in terms of pitch decks change over the time when it was like nobody could miss, a few years ago? It didn't really make a difference. Everyone was going to have these huge IRRs. But now I think even new investors are looking and fine-tooth combing it more, because they're worried, because there's a lot of bad news out there about syndications and what happened and what the issues were. So has that changed kind of the way that you're presenting the information for your clients?
I think it's become more and more important to be tight around the messaging that you're putting into the collateral. It used to be the case that you could drive pretty good returns just through kind of I don't know, I hate to use the term, but like the financial engineering aspect of your deal. So, buy something, maybe you cash out refi in 24 months and return a bunch of equity and things look great.
Well, that's really important, though, because you used to be able to do that cash out refi in like 2 or 3 years, and now you can't.
That's exactly. That's my point. I agree entirely. And so it's now probably much more important to put a focus on the operational aspect of the physical asset.
Yeah.
And so we've been putting together collateral that focuses quite a bit more heavily on that in recent months.
Yeah, and I mean, I think that's really helpful. For at least me personally, I'm very still interested in the asset. I'm not just like dunking it in. I don't look at the returns at all, which is crazy, because I'm trusting the operator. But I'm also, like for me, being an LP, I like that I can invest in another city that I don't want to have just a couple properties in. So it gives me access to this area, multifamily, which is what I invest in, but also to geographical areas that interest me. But yeah, again, my personal thing that I always look for is the debt, especially still now. And I think that's one thing that new investors maybe gloss over, because as we were just saying, sure, if you have something floating, you're just not going to be able to refi right now. And that's where a lot of people got in trouble.
Yeah, I completely agree. And that flows through to the financial modeling side as well. You may need to to kind of change your position on that, impacts the collateral. And then I think it also is, we're seeing more and more, we do a lot of quarterly investor reporting, and we're seeing that messaging shift more toward, hey, this is what we're doing at the physical property. Maybe, in the case of a retail center or an industrial, hey, we're doing this restriping project on the parking lot. And it's the narrative has moved away from, hey, we just refied the loan for like the third time in the holding period kind of thing.
Yeah. I mean, you got to send something. I mean, if I look at my LP investments, 3 of them were more turnkey, and one was not necessarily like, value add, but they were doing stuff. So like that one, I get more updates on like, changed out the leasing and the numbers. And the other ones is just more like, hey, here's our rent, 98%. And this is how much we're up in rent. So I don't really have to worry about it. But yeah, I mean, I think these things are all important. What you're really shining a light on is that the messaging that comes across is so important. And I think if the top people in the company, as we were saying in the beginning, are busy on, capital and investors, it's something that they could neglect that could have a long-term effect on the viability of the product and of the the long-term gain.
Yeah, I completely agree. I mean, it becomes a level of service conversation at some point. So, what kind of service are you going to provide to your investors? And that's what we're here for.
Yeah, but that's kind of the tightrope for some sponsors, because you have to make it attractive. So, it's a pitch. It's called the pitch deck. So you're really pitching to get money, but you also have to kind of make sure that you can back it up. Because I mean, like, I'm sure I've seen plenty where I'm just like, well, this is just, a mirage. This doesn't even make any sense. You get to the fine print, and it's like, 9% floating rate debt. And you're like, whoa, that's interesting. That's not something I was expecting. And I mean, I think that probably makes it an interesting conversation for you with some of your clients, where they're really, pushing sales when they're new, which they have to. But hey, we don't want to overpromise. We want to underpromise, overdeliver.
Yeah, and I think that overpromise and underdeliver dynamic, I mean, you can kind of view that through two different sides too. It's like the financial performance side. So, what are you telling folks that your deal is going to do in terms of performance metrics? And then it's also on the investor experience side, so if you're promising them that they're going to have 24/7 access to a portal with all this great information in it, and you'll be providing updates, every month or whatever. And then, you find that you can't actually do that because you're out there raising equity and reviewing deals. That's another aspect where a lot of shops, especially smaller ones, fall short.
Yeah, I feel like the portal is kind of like a security blanket for LPs. Like, I go in there, but I've gotten the emails, so I'm just kind of like, it's a syndication. There's nothing really to check on. You know what you're getting. You're going to hear if it's eventually going to go, when it's going to go full cycle, or what the plan is. But it does feel nice to be able to log in and say, like, okay, I'm just check the percentage of investment that I have. That's really what I do. I'm just like updating my numbers for somebody.
Sure. So, we have a viewpoint on kind of like best practices for a portal tool like that. You've called out one use case, which is kind of that ongoing, LP logs in, they get to see some documents, maybe investor reports are logged there or whatever. It's important at tax time. I mean, a lot of our clients distribute K1s through that. So that's good. The other thing that these tools allow you to do, though, as a sponsor, as a GP, is to show your whole track record up there. Yeah. So if we build out the back end of that correctly, a new or a prospective LP would be able to go there and see, all right, the sponsor has done, half a dozen deals in the last few years, and here they all are. I can click through, read about each one, understand kind of the nature of the project. Was it a value add? Was it something else? What did they do there to add that value? What was the outcome? So it becomes sort of like an augmentation of your core pitch deck. Yeah. And, it kind of stands there as this portfolio that you can show to prospective investors. And so when we build out these portals, we're doing it at least as much for that purpose as we are for the purpose of, allowing you as the LP to go and download your report.
Yeah, that makes sense. I mean, I like it when 3 of my 4, LP investments are all with the same company. So when I go in now, I can look at all 3 of my own and compare them all to each other, which I like. And I think also the ease of use for getting your capital in is nice when you have a good portal instead of having what are we all worried about? Wire fraud.
Right.
So it's like, I want to know the portal. I want to know who I'm going to call to confirm because I like to wire instead of ACH. And I think that's a really important the portal, because you can see that they've received the money. Everything comes in email, but like a lot of people's emails are, 12,000 in the inbox. So they're missing it. And if they have the availability, like you said, maybe, they're just having a freak out moment and it's, 1:30 a.m. and they can just log in and go, oh, no, my money's still here.
Yeah. No, I hear you on that. I think the other place where it's really helpful is where you as the LP is going through the commitment process for the first time with the sponsor. So we'll build out all of the documents that need to be signed. We'll build them into the system. They become e-signable. They get auto recorded. We actually take it a step further, and we're happy to sort of handhold individual investors through the process if they're having trouble. So we kind of moonlight as this IT support, I guess you could say, where we're making sure that everybody's kind of comfortable going through the process. And you'd be surprised how often that becomes an issue.
I think it's like when someone's scared, they're making their first, they're sending $100,000, they're just going to be in panic. Like, I don't even read the stuff because I've already done my research. So when I get the signing docs, I just sign them. Maybe that's dumb, but I don't have time to read that much. But I can see why a first person would have a question on, line 72. They need someone to talk to so they can, because if not, their money is going to be in limbo. Maybe they committed the 100 and then they never sign the docs because they're confused, or also they're just like bad at, e-sign.
Mm-hmm. Yeah. You'd be surprised how often we see that. Some of our clients are raising equity from international investors, and that brings some challenges of its own, so we're kind of there to steward folks through this process, regardless of what their situation is.
Hey, it's Jonathan. I hope you're enjoying this episode with 2 of the most monotone people ever, me and the Silent Assassin. You'll hear why I call him that at the end. But if you're interested in getting more information about how Mike can help you with his company, you're probably in syndications or funds and you need a little help on the back end. Go to lexcraftadvisors.com, set up a call with Mike. Let's get back to the show. Yeah, so in your work with sponsors, you've obviously been able to see what works as capital raisers or what characteristics people have that turn into a good syndication. What are the characteristics that the best kind of capital raisers, and I would say capital management people have that you like working for them because of those characteristics?
Yeah. At a high level, I think that in the space we work in our little corner of this industry that we work in, we see at a high level 2 different practices for raising equity. One is what I call kind of like raising money at mass scale. So we have a couple of clients, they have a team of people that kind of like working the phone, like a I don't know, an IR team or some
putting
kind of
a lot of ads out there to bring in inbound. It's kind of more like spray and pray wholesale marketing.
Exactly.
Get as many calls as possible and then lever through who's there. Which, if you have the support staff, it works great. But if you don't, you're just going to flood yourself with a bunch of garbage calls.
Yeah,
someone's like, "I'd like to invest $3." Okay.
Yeah, and I don't think, I'm not sure if that model has been 1,000% stress tested yet. In a serious downturn, what does investor flight look like for that model? I don't know. I don't know. On the plus side, it certainly enables scale, and it can be tremendous scale if you can get it right.
But it's sorry, before you get to the second part, it's also part of brand building too when you're doing that. So taking those calls is almost massaging future investors. Maybe they're not ready right now, but being able to field those calls is just putting more people into the future cycle after you have a couple outs to show, hey, we've got it all taken care of.
Yeah, I guess from a sales perspective, you could think about that as like the top of the funnel or close to the top of the funnel, and then what is the time to actual commitment? And there are shops that do measure stuff like that. So that's one way to go about it. I'm not saying it doesn't work. It clearly does, and it can work very well. And then the flip side of that coin is doing it in a more of a deep relationship centric way. So we have some clients where they rely on the same investor base deal after deal. I'm simplifying, but basically that's what's going on. And so they've created this deep level of trust with a few core investors, and they tend to get repeat contributions from those investors. So that can work very well. I kind of have this hypothesis that that's the stickier of the two.
Yeah.
We'll see if I'm right or wrong on that. But I think that it kind of depends what the sponsor's objective is. I don't think there's necessarily a right or a wrong answer. I think if you're looking for, to have those close-knit relationships and kind of focus on maybe a small handful of projects at a time, working with people you might know pretty well, great. That can be a perfectly viable model. In some cases, we've seen those kinds of sponsorship groups really, hone in on just to the point where they're looking at, 2 or 3 projects at a time, but they tend to be larger. Yeah. So, the concentration of capital kind of grows over time. So, like I said, I think either way can work. It's kind of a matter of where the sponsor wants to direct their business.
Yeah, I mean, I feel like they always still have to be doing more, because if they're bringing in more deals, like not all of your investors can go into every deal.
Right.
It's just like how much, because I'm waiting for them to go full cycle. So when it goes full cycle, great, cool. Then I'm going to put it back into another deal. But, for now, I feel like, at least for myself, I'm kind of like tapped out on my syndication investments now. With 4 of them in. I'm just kind of like, oh, let me see what happens and wait for one to score and see. Yeah, it's really, I mean, syndication's been really interesting. I was telling you before, when I started this podcast, that, even after 30, 40 years in the game, I really didn't know much about syndication, but so much goes into it. And this episode is another indication of just how much is done behind the scenes that actually helps both sides, helps the sponsor not have to work on it themselves, but also helps these limited partner investors understand what they're getting themselves into. And I guess as part of the docs and stuff for the background, it's really important for investors to know, that this is an illiquid asset. It's not like, investing in a multifamily that you could turn and sell. And I feel like that's part of something, maybe it's not at the top of the pitch deck to scare people off. You can't get your money back, but it's certainly important in the back end to make sure that people know, this is the expectation of the time frame. And it's no longer that 3 to 5 years. It's more like, 5 to 8 to 10 years now, right?
Mm-hmm. Yeah, I think that's right. And I think that gets back to a little bit of what we talked about at the beginning, where it's one of our missions is to sort of free up sponsors to go out and network with investors, source that capital. Yeah. And I think that, it's through that process that I think the most successful ones are good at targeting the types of investors who A, understand that illiquidity aspect, and B, are prepared for that and are sort of on board with that. And, that fits within, their broader investment strategy. So I think, through the work we do, in my mind, it almost frees up the general partner, the sponsor, to really hone their skill in terms of how they're going to market and kind of procuring this roster of potential investors.
Yeah. I mean, we talked about the sponsor's avatar, but just so people can get clear, like, who's your ideal avatar for a client at Lexcraft?
Yeah. So we are working with, generally speaking, private equity real estate sponsors. So that covers folks who are operating on the syndication side of the business, as well as the fund side of the business. We focus squarely on the middle market of this niche. So, if you want to measure it by like how much equity our sponsors are managing, on the small end, we will take on what I call emerging sponsors. They might be managing, I don't know, under 25 million in equity, let's say. And then on the higher end, we're working with sponsors that are managing up to, I guess, about 300 million in equity now, and kind of everybody in between. So I think once you get over that 300 million mark, then it's kind of like what I talked about before. Our services become sort of more targeted to one aspect of the business where somebody just needs the support, and that's fine. We're happy to do it, but that's kind of a target profile.
Yeah, and in the back end though, because a lot of times, I have a lot of people who are doing, one-off syndications, which is just one asset, and then obviously funds where there's multiple assets in there. Your pitch deck's a lot different for those, because when you're doing work in the back end for a fund, it's not just based on one asset, and also they may not have all the assets in the back yet. That's probably a little right. And I was thinking while I was driving yesterday, like, funds must be tough. I was listening to an episode of the podcast with somebody, and I was like, yeah, I mean, funds, it's a totally different pitch, because you have to have more trust on the fund, because there's no asset or assets in the tank backing it.
Yeah, and that's especially true in the case of a blind pool fund, where you as the LP, you might not even know what the fund owns.
That doesn't sound good to me. I'm too much of I'm a control freak who's learned to release control in the syndication game, but that's just going a step too far for me.
And that's fine. I guess to all the blind pool sponsors out there, Jonathan's not your guy.
Yeah, well, they're probably pulling slot machines because they think it's fun, but yeah, that's not my game.
Yeah, no, I think you're right though, in the sense that the equity raising process for a fund is different. The messaging is different. We typically focus that a lot more on you usually can't focus it on a particular asset, because it might not be in the portfolio yet.
Yeah.
Instead, you're focusing it on the strategy, and that strategy could be, the asset type, it could be the geography, it could be, is it a value add or something else? So there are different ways to kind of slice and dice that. But, that's usually the core of the messaging. And then we're trying to drill down on that. So, if your strategy focuses on a particular MSA, we're going to go deep on that, and that's going to comprise a chunk of your pitch, and explaining to folks why over the next 10 years this is the place to be, and this is the asset class within that place to be in, and on and on. So that's typically how we handle that. Obviously, it differs from the syndication in the sense that you can't pinpoint a particular deal. You're not going to be able to show, asset level financials or underwriting or anything like that. So
yeah. Based on your experience of what you've seen and who you're managing, are you finding any of the syndication asset classes doing better in today's current environment than others?
I would say anecdotally, we've seen certain industrial asset classes do quite well, and especially in certain geographies where there, for whatever reason, there seem to be supply constraints.
The cost of construction is lower on that than obviously multifamily, or even, similar to self-storage in some ways, but even less for industrial.
Yeah, I'm kind of getting outside my swim lane a little bit here, but from all the work that we do, I know there are certain markets where supply is constrained for reasons aside from cost. Maybe it's red tape or regulatory or permitting or whatever it might be. That's kind of a city by city thing.
Yeah.
So, we have some clients who have sort of identified those places and have had good success acquiring existing stock in some of those cities. So that's kind of an example of something that's worked well. I think if anybody out there is raising equity for a multifamily development right now, especially in like a tertiary market, that's hard. We've heard that from quite a few of our clients. So
if it's not A class, just give up. It's not. That's what everybody said. It's like no one's building not A class, but then it's hard because you got to find the B class in there somewhere, and that's where those older assets on the turnover can work out well. But it's still a longer payday for the LP on those.
That's right. Yeah. It's a matter of finding LPs who are willing to kind of ride along with something like that, and this is not a new thing. I mean, for the last couple of years, this has been a challenge for a few of our clients, and I don't know what the future holds, but I can say that it's been a challenge.
Yeah, last thing, I mean, in the back end and in the deliverables and in the operational side, if a syndication is, in trouble, maybe not to the level of a capital call, I mean, this is where the back end becomes really important, because you want to make sure that they've been updated on everything, because, people are checked out like me, don't read everything. And you're really covering the legal bases as well, just to make sure, hey, we've delivered this, we told you what was happening, and now we're in this situation. That's where the back end portal and the communication that goes out becomes really important, is in a time of like at least modified distress.
Yeah, I would definitely agree with that. We've seen a couple of instances, even fairly recently, of stuff like that. Maybe it's a development project where something doesn't go right.
Yeah.
So that usually warrants sort of an interim statement out to the investors or something like that, some kind of communication to let them know, hey, this is kind of an issue right now. We're working through it. Here's what we're seeing, on and on. The other thing we've seen work pretty well, I know you're a big video guy. We've seen some sponsors migrate toward video updates that go out through the portal, and those get received really well. I think a lot of times those written updates kind of get, ignored or tossed aside, but the video seems to get consumed at a higher rate. So, to anybody listening out there, I might suggest, give some thought to that.
Yeah, I mean, it just seems like a better move if you have to deliver, some level of bad news or slowdown in a project or payment. It's just better to do it modified face to face, which video. I'd prefer that as well. At least I'd get a better idea of what, especially for monotone folks like us. It's like the video helps because we think we're being funny, but nobody knows that we were even joking, right? I mean, this is just like, the trouble with having no ups and downs.
That's right. Yeah, I think something like that becomes especially important, like you said, in a time where, maybe the project is not running as smoothly as everybody would like it to. So
yeah,
we have seen the video aspect kind of put certain folks at ease, where I don't think a written letter would have achieved it to the same extent.
Yeah. Well, I mean, it's still about building trust, and you still have to maintain that trust. And if you go off track, and and that's where the transparency, I think, is important on all aspects. Sometimes could be hard for you because you're not going to, you'll be able to see the docs, but you can't act outside of what the sponsor wants you to do. So you're like, really think we need an update here, like, let's go. So that becomes probably a difficult thing when somebody is trying to wait to see if maybe the 1% chance that something goes well is going to happen first.
Mm-hmm. Mm-hmm. Yeah, I mean, we've even seen instances where something's not going well, but through the power of the communication, the sponsor is able to maintain the relationship with the investor base, and that's huge. I mean, that's, in some cases, that's everything.
Yeah, I'd rather know up front, know exactly what they're trying to do, instead of just getting like hit with it all at once. Here's where we messed up. Hey, can we have some extra money? Also, sorry, but not really. Yeah, awesome, man. Is the best place for people to get in touch with you through lexcraftadvisors.com?
Yeah, so that's right. We're on the web at lexcraftadvisors.com. You can also find me on LinkedIn. We have a company page on LinkedIn. You can find us there. Through email, we have an info@lexcraftadvisors.com. So I'm happy to, we monitor that every day.
Yeah, I mean, people don't know our voice tenor in the email. We can actually, my emails are monotone too, or yours. Like, I mean, it's just funny because we really, I've known you for years, and we share this like similar personality, where people like texting me like, is something wrong? I'm like, no, I'm just answering one word in a text. Like, what do I care?
Right.
Are you the same?
Yeah, no, I'm the same. Emojis help. They help communicate, what I'm actually feeling, even if it doesn't come across otherwise.
I know, but it's like it almost hurts to put the emoji sometimes, right? It's just like this is going to help someone, but it's really annoying. It just looks dumb. It's not.
It's a little unnatural.
Yeah, exactly. Yeah. Well, as we close it out, I just want everyone to know that my nickname for you is the Silent Assassin because of your monotone nature. I've been calling you that for years, and we're part part of the Monotone Club. But thanks, man. I really appreciate you coming on. I think it was a really enlightening episode for the backside of syndications, and certainly for newer syndicators who are looking to get in or just started, like making sure, hey, here's some check boxes you need to look at before you mess yourself up. So thanks a lot for spending the time.
Yeah. No, thank you, Jonathan. I appreciate you having me on. It's been fun.
Yeah. Totally fun. All right. That was Mike Zane. You can find him at lexcraftadvisors.com and all the other ways he told you. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 271 of Zen and the Art of Real Estate Investing. And it's Derek Morton of Net Gain Property Management. He's based in Utah. We're talking property marketing, tenant screening, maintenance and repairs, and getting results for your investment. This is a property management show. We'll see you next episode with Derek.